All right, Luke, looking at the list that you send me of the movers, there are a couple of big moves. We have 125% higher for 55 North Mining, but no specific news this week. This one seems to be running on previous news from an exploration agreement with their First Nations there. But overall, if I look at the list that you send me, most of the moves, it says no news. Is there something specific you wanted to talk about this week?
Not really. No, it's there's not much news that interested me this week. Every week I make the list again. I look at the biggest movers up and down, and then I add the news of that week and the news of the weeks before since this week. And there's nothing that really jumps out to me. Maybe there are certain developments that companies think are significant. That could be, for example, the PEA that Lithium Bank released, but nothing that I have a real idea of, good or bad, this week. So that's why I decided. I think everybody is sort of looking. Where are we in the sector right now? Are we at the end of a bear market, or are we in the middle of it? Where are we exactly? And every now and then, even though I'm not a really like a major follower of macro trends and big moves in the world. This week I decided to make a couple of charts about gold, about GDX or UE index, and see where we stand. And even though it's impossible to exactly know what will happen, try to review the current situation a little bit. So what I did is I took the gold price, I took the UE price, something similar to the GDX, so gold miners, and I mean, as most people know in the sector, that gold is sort of outperforming overall. All these miners are going up and down like crazy all the time, very volatile. And in good times, like early 2016 or middle of 2020, you can better be in a miner because it will go out 3-4x in just months. But overall, gold is performing better. And by dividing those two, the prices, you get the relative value of the UE, and that's, I think, right now at a sort of historical low again. This level was reached in 2015 when we were at the bottom, and also in 2020. But we have been moving around this bottom already for quite some time. So is this going to be that indicator that's telling you should buy it right now? I think it's a nice indicator because in December the UE reached a sort of low, and if you do some technical analysis, and I asked some people to look at that for me, it seems to be a bit of a bottom, but who knows? So I decided to look a little bit further than not just to these gold indexes and gold prices. I looked also at the TSXV, which is seen as a junior or very small minor index, even though nowadays it's only 55 or 60% mining related, and the rest is technology and other things. TSXV moved a little bit different compared to the real gold indexes, but it didn't really have that big move between 2015 and 2020. It was just a relatively small uptick compared to the gold miners. And the TSXV shows this massive bull market like the gold did in the 2000s, the early 2000s. Then it crashed in 2008 and came back up again. But since 2015, it didn't really perform well. It's still very close to these all-time lows. And so the TSXV is at a low. The GDX or the UE versus the gold price is at a low. So it's pretty obvious that miners, especially small miners, are not doing well. Then you look at Newmont. Newmont just went 50% down from their high, but that's in a very short period of time. So I think it's quite difficult at this point. I think we need a sort of strong move up or down to decide where will the next months go. I think we are not there yet. That's my conclusion right now. I think it's especially because summer months are often weak. The charts are not completely giving that completely oversold signal yet, I think. And it leads me to believe that we are not like in a 2015 period yet, where every company, even decent companies, are trading at $5 or $10 million these juniors. They're actually there's still a little bit of speculative value in them. In a minute we can have a look at a couple of junior miners and why they trade where they trade.
I guess that's about the thing with ratios, right? Because they show you, I mean, not maybe, they show you the relative value of stuff. So relatively, stocks are not cheap to gold. Sure. Does that mean they're going to start going up tomorrow, next month, or in 3 years? I mean, things can, cheap things can get cheaper, and expensive things can get more expensive. Look at Nvidia this week. I mean, we're not talking about that, but I guess it sort of proves the point, although they did come up with interesting results too. But anyways, the point is that there's a lot of other stuff that influence the movements of stocks. And I know that a lot of people look at it and they're like, oh, this is so low. This ratio is so low. This has to sort of explode. And a lot of people go in with a faulty perspective of when these things are going to move. So basically people go in hoping for a short-term return. And that's not necessarily the case, though. Ratios can show you the relative value of stuff. And it's better to buy cheap than buy expensive. I get all these things, but that's also just doesn't mean that the stocks are going to start going up right now, because we also have a macroeconomic background that's challenging. Central banks confirming that at least some type of a recession might have to come. Copper is falling, which they call Dr. Copper, while gold is staying relatively strong, trending up on the year. And that gets people nervous too, right? So yeah, cheap, sure. Does that mean that the increase is imminent? I don't think so. That's sort of the way I look at those.
Yeah, and I think you make a good point. I didn't look at Nvidia, but I'm looking at it right now. I think, if you are an investor and you're not specialized in these tiny micro caps, like probably we are looking at all the time, and you have to move bigger sums of capital, why would you put your money into a sector that only performs for a year or 2 years in a row and then gets this major crash again that we all know will come every time? And if you look at Nvidia, I mean, if there was no rollback or anything like that, it went from $3 maybe 10 years ago to $400 right now. I think Netflix and Tesla and Apple and Google, I think they provide these returns if you find the right stock, and you can get better returns than compared to a mining company. So from that point of view, indeed, I mean, if you look at the chart that we looked at in the beginning, the gold price versus the UE, I mean, the UE between 1996 and today didn't move much. So why invest in a miner anyways if it doesn't move much? The price of gold went up from $300 to $2,000, and if you cannot make sustainable growth in companies in the stock price, then why even invest? And that's why I prefer to look at the tiny juniors that we are investing in. And you have to position yourself at some point if you want to make these big gains. And I think, especially if you position yourself in the market, you cannot do that within 2 or 3 or 5 days, because the volatility or the liquidity is not there for that. The volatility certainly is. So you have to position at some point, and like in 2015, you have a couple of months to position yourself at the bottom, but you never really know where the bottom is. That's why I looked at a couple of companies in 2015. I looked at where did they trade, what sort of market caps, and you see, for example, Mirasol did have 22 million in cash and a market cap of 30 million. Abitibi, something similar, was trading at cash. Abitibi Royalties. You had companies like Radius Gold trading at cash of $7 million. You had Manduro Capital trading at about, I think, half its cash, if I'm not mistaken. So these companies were really trading at cash values or below cash values. So we are not there yet. I mean, I think there's still speculative value in companies with a story and potential and land positions, but not much else than that. They still trade at premium valuations because they get some value for what they claim they may find. And in 2015, they didn't get much speculative value in the stock at all. If will we ever go back? Well, ever probably, but will we go back to 2015 type levels where companies trade at market caps close to cash levels? I doubt it right now, especially because the gold price is high and we had a couple of nice moves in 2020 and 2016, but we didn't have that massive rally, I think, yet compared to the 2000s and the 70s. If you look at, for example, Orion or Probe, I also created 2 charts of them. I mean, you see working capital. I mean, these are 2 companies at that time they were just in starting up phase. They were looking for projects or acquiring projects, and they were very early in their journey of finding a project and creating projects that make sense. And Probe was trading at its working capital, and Orion was also trading like at a $2 million valuation. So there was no speculative value in it. It was just, it was just not negative, so to say. They were trading close to negative values because of their working capital positions, and ultimately the companies that created good land positions and good projects and results, they went to 100 million, 200 million, 300 million valuations. So my story, I think, is that, or my conclusion is, if you would create a list of companies between $0 and $5 million right now, and you would just look at them one by one, I guess that in 2 or 3 years' time, there will be 100 bagger in there and probably 500 baggers in there, like you can find in the tech space. But when to position and how to find the right one, that's of course the big question we normally talk about when we look at the news every week and we talk about specific stocks. It's not easy, but I think that's the opportunity here, to look for those things that already bottomed and that are already trading like Orion was trading in 2015 or Probe was trading in 2015, sideways, not looking anymore for a bottom, just being at that flatlining phase where it's just waiting for a new market to start.
I think there's 2 very important points in these things that you said here. So first of all, I don't remember who told me that, but someone might have told me that, or I might have read it somewhere, is that you don't only want to look for things that are cheap. You want to understand why they're cheap, and you want to understand why they're going to stop being cheap. So that's the first point, and it's kind of an interesting point because I'm naturally attracted towards things that are cheap. And my prior approach, which has lost me money so far, was to just buy whatever was cheap without really thinking, hey, why is it cheap? What's going to make it stop being cheap? And to figure out what's going to make it stop being cheap, you have basically 2 approaches, right? You have top down and bottom up. Top down means you look at the macro, you figure stuff out as in, okay, I'm in a copper explorer, copper inventories are low, for example, and there's a big demand push coming out of China that's going to make it stop being cheap. That turned out not to be true this time around. So now we have the opposite thing where copper stockpiles are increasing. Demand of China is not as strong as it was expected to be. And so what that results in is that top down, if you're doing a top down research, most of the times right now you would come up with a reason saying, well, there's no reason for this thing to stop being cheap at the current time because it seems like we're going to be going through some type of economic turbulence. I'm not going to call the end of the world here, but some type of economic turbulence seems highly likely at this point. But then if you start looking at the bottom-up approach, that's when it starts getting interesting. And that's what you just hinted at. Bottom-up means you start with the company. You start figuring out, hey, what's going to make it stop being cheap? Like this company, for example, they don't have an exploration agreement with their First Nations, but they're talking to them next week. And based on what they've said, or I don't know, you follow their First Nations on Twitter or whatever, and then you've seen that they communicated something and you're like, I have high expectation that they're going to get the exploration permit. That's going to increase the value of the company. So that's going to stop this from being as cheap. Or you expect the drill hole. You've seen some of the pictures of the core. You analyze geologically and so on and so forth. So, first point is figure out what's going to make the thing stop being cheap. And the second point was the bottom-up approach is the one that is more likely to make you money in this market if you understand what you're doing. Would you agree with these points?
Yeah, and I think indeed cheap is also like, what is cheap really? I was referring to $5 million companies, but a $50 million company, even in our microcap space, could be very cheap. because indeed it is driven by news releases. For example, a First Nation agreement or a discovery. If you look at the 10, 15 recent most significant discoveries, they didn't start at $5 million. They started at, like, Philo Mining was a $400 million stock when they made the discovery of the high grade zones and the system that they're working on right now. While Patriot Battery was 10 million. Snowline was probably, when they released essays, 400 million. NGEX was 700 million. Chalice was 40 million. So you don't need to always look at the $5 million stocks. In most cases, those are not the companies that are making a discovery. Often they have progressed something further along to a certain point where the valuation is also already at 50 or 40 million. And then they make that significant news release of a discovery or anything else that really propels it. So indeed, I think it's good to say that it's very news driven. That's also why it's risky, because if that news falls in the wrong direction, then it will also go 50 or 80% down in a very short period of time. And I think it's important to note that even though I enjoy looking for these $2 or $3 million companies, sometimes it's better to just look for the 30 or 50 or $80 million companies, or even $100 million companies, because if they make a discovery and it's significant, it can still become a 10 or 15 bagger. So summarizing, I think to really find opportunities, you need to look into the stories very specifically, and you can almost not invest in an index or invest in one or two big miners and expect, because of whatever fundamental reason, that in 3 years or 4 years time it's looking much better. I think this is really, it will always be a stock picker's market, and of course timing is important too, but in the small stocks you could also do well in a sideways market, I think. So yeah, if you want to invest in something and not think about it for 5 years, better go to Nvidia, as you said, or maybe Tesla or Apple or Google. But if you want to, I mean, this is I still think that this sector, even though it's tough for people, I would say like us, retail people, this is a place where it's easier to find your 50 bagger or 10 bagger, in my opinion, than in the big tech world, because that's not, the companies there are often more difficult to analyze for a retail investor, because the tiny companies are not listed yet, and the big companies, you just don't have access to the management team. You cannot call them up, and in this business, you can call them up and get a good feel for what they're doing, and then stock picking can be very lucrative.
Yeah, I agree with almost everything. I don't think it's always a stock picker's market. Like there seem to have been periods in a time before where a rising tide lifts all boats. So you could just pick any boat and you would make money and you would outperform the market in special situations. And I think that good top-down investors could do that. So like your Stanley Druckenmiller or whatever, who sort of has a nose for these things, they can do that. But I think right now, specifically, and this sort of the conclusion of what we've been talking about today is it's not the time to just blindly buy whatever, because top-down just doesn't work right now. It's the time to, put your head down, do the actual work, and figure out what's worth it. I mean, look for companies that are trading close to their working capital and have a plan and not overspending on promotion, but are still drilling and so on and so forth. So, yeah, in conclusion, not the time to buy blindly, but the time to do the work, basically.
Yeah, I think you can never buy blindly, but I think a good indicator is, I mean, you want to be invested, because if you are invested, you will also feel it a little bit more. If you just look at the charts and you follow it, you're in it in a different way. If you experience March of 2020, the first 2 weeks of March 2020, then everybody just felt the pain. Everybody, even the big names. It's very painful, and once it really becomes painful and it starts to be really stressful, that's often when you need to act. So it's not often in a sort of relaxed moment where the stock is going where the market is going sideways, where you can decide this is the best point. Often you need some more pain before it actually starts to become really interesting, and you can almost buy blindly, even though that's also probably impossible. But so I agree. I think even though we are very well, cheap. I don't want to use cheap too much because it's not necessarily cheap. We are pretty low relative to gold. If you compare the UE to the gold price, I also don't think we are not there yet. We need some more pain, maybe over the summer, and see our positions shrink a little bit more before it's time to put up more capital. And of course, I'm also buying stocks right now. Not a whole lot, but I'm buying because I do see opportunities, but not necessarily for the next 3 or 4 months, but more. Those things should come to fruition in a year or 2 years. But sometimes it's good to be in time and maybe a little bit too early.
I think those are all good points. If, again, bottom up strategy, if you found something that you really like and it's really cheap right now, sure, why not take a starter position, see how it develops? You keep following with the company, because when you have a stake in a company, it makes you follow up and research and learn more about the company because you've actually staked your own money. Hopefully it's not too much, so risk management is still important there. Hopefully it's not with your next rent money or with your vacation money for 3 months down the road, because nobody really knows what's going to happen. But yeah, no, I think those are good points for today. Anything else you want to talk about?
No, I'm gonna enjoy the nice weather today here in Holland, and next week we'll talk again. And like we always say, hopefully with some better news, because even in a bad market, some amazing news can certainly change a lot of excitement, and people will be all in again.
Yeah, let's hope. Otherwise, we're gonna have to keep coming up with topics to discuss that are not news. But that's still fine though. So
Yep,
yeah,
certainly.
Yeah. All right. Thanks a lot for doing this.
All right, thank you.